Stuck with a 3% mortgage rate and feel like you can't ever move? How open-minded are you about a loan that makes a 7% rate feel a lot less scary? The market's wild right now. Home prices are up, interest rates, they're not going down as fast as we'd like them to. And if you're like 90% of homeowners, you locked in a super low rate in the past and you feel trapped. You'd love to upgrade your home or move for that new job, but giving up your cozy 3% mortgage for today's 7% rates? No thanks, right? This scenario, it's called the mortgage rate lock in effect. People literally staying put in homes that they've outgrown just to keep their low loan rates. Today, I have some exciting news. I'm not sure if this is for you, but what if the interest rate wasn't the be-all, end-all of your mortgage costs? The all-in-one loan offers a new perspective that can set you free from the golden handcuffs of a low-rate loan. We're talking about a mortgage product so innovative that even at a higher rate, it can potentially cost you less than a traditional loan at a lower rate. Sounds crazy, right? Well, would it be ridiculous to imagine moving to your dream home even if the rate is double and still coming out ahead? Let me break it down. The golden handcuff reality is this. Roughly 8 in 10 homeowners have rates under 5%, and a full 22.6% have rates under 3%. If you're one of them, you probably feel pretty lucky and also stuck. The idea of doubling your interest rate by moving is terrifying. Even if you could afford the higher payment, it feels like throwing money away when you had it so good. That's why home sales, they've slowed. Who wants to trade a 3% mortgage for a 7%? This interest rate trap has made many people cancel their moving plans, stay in homes that might not fit their needs, or hold off refinancing even when they need cash out. It's a big problem in today's market, but here's the thing. The interest rate isn't the only factor in your mortgage costs over time. We've been conditioned by a 30-year fixed loan to obsess over the rate because that largely dictates your payment and your total interest. However, what if you had a loan where your principal balance drops much faster so you didn't pay interest for nearly as long? In that case, a higher rate can actually offset, maybe even more than offset, by the fact that you're paying interest on a shrinking balance over that shorter period of time. That's exactly what the all-in-one loan enables you to do. It changes the game from what's my rate to how is my interest rate calculated and for how long. This is a huge underutilized benefit to focus on principal reduction and loan flexibility to beat the tyranny of that interest rate, that 30-year fixed rate. So how is the all-in-one loan? How does it offer an escape? The all-in-one loan, the features are tailor-made for this environment. Principal first, interest second. In a traditional mortgage, your first payments are mostly towards interest. You barely chip away at the principal in the early years. In the all-in-one loan, by contrast, every deposit you make goes 100% to principal first. Interest is only charged on the remaining balance. So from day one, you're paying interest on a smaller and smaller amount. Even if the rate is higher, the amount the rate applies to is dropping quickly. In addition to that, 100% of your income is used to offset the balance. With the all-in-one loan, you utilize all of your income to offset the balance until you spend it. Think of it like this. In a 30-year fixed loan at 3%, if you had $5,000 sitting in a checking account, it's doing nothing for your 3% mortgage. In the all-in-one loan, say, at 7%, that $5,000 would actually reduce what you're paying the 7% on. Over time, this can dramatically reduce the total interest paid. You're leveraging every dollar you have to fight against that higher rate. It's daily recasting of your payments. Traditional loans, they lock in your payment for 30 years, unless you refinance. The all-in-one loan, it recalculates your interest costs daily, and your required monthly payment adjusts downward as the balance falls. This means as you make progress, you immediately benefit with lower required payments, improving your cash flow continuously. It's like automatically refinancing yourself little by little every single day without any paperwork. It gives you liquidity and flexibility. Here's something that no fixed loan gives you: the ability to pull money back without refinancing. With the all-in-one loan, if you need some of those prepaid principal dollars back for renovations, investments, emergencies, you can borrow them via the line of credit feature. There's no penalty or huge hurdle. This liquidity means that you're not afraid to deploy extra cash to your mortgage because you know that you can actually retrieve those funds. It encourages you to pay down the principal faster than you might otherwise do. And it protects you if life changes, a job loss, or something happens, family increases, or whatever, acting as that emergency reserve. Why does the 7% all-in-one loan beat the 3% traditional loan? Well, let's do the comparison. Suppose you have a traditional $300,000 mortgage at 3%. Over 30 years, you'll roughly pay $155,000 in interest. Now consider you move and get a $300,000 all-in-one loan at 7%. Sounds high, right? But because you deposit all your income and drive down the balance, you're not paying 7% on $300,000 for 30 years. Perhaps with your cash flow, you effectively pay the loan off in, say, 10 or 15 years. Maybe you end up paying $100,000 of interest in that time frame. That could actually be less than total interest than sticking to that 3% mortgage. In fact, the all-in-one loan might let you move. It will take a higher rate, but still pay less interest overall and debt-free sooner than if you keep that low fixed rate loan. I know it sounds like heresy in the mortgage world. We always say, take the lower interest rate, period. But with the all-in-one loan, that advice turns it on its head. It emphasizes how much you borrow and for how long, not just the interest rate. It gives you control back to the borrower. Many of the all-in-one users treat their account like a game. How can I get my balance down this month? And as they do, their interest cost, it plummets. Consider also inflation. At 7%, a traditional fixed payment is high initially, but it stays the same even as the inflation makes other future dollars cheaper. But with the all-in-one loan, as you pay down, your payment recasts lower. You're freeing up cash flow in the future, effectively hedging inflation. One could say that the all-in-one loan is somewhat of an inflation hedge because your debt balance and your payment shrink over time, erasing or easing the burden of what other costs might be rising at the time. Meanwhile, the 3% fixed, that your payment is low, but you're stuck with it for 30 years, regardless of life changes or inflation. This loan, it makes moving or refinancing viable again. The underutilized benefit here is mobility and opportunity. Look, life changes, families grow, jobs relocate you, opportunities to invest or buy a second home come up. You shouldn't be handcuffed by your old mortgage rate. The all-in-one loan can make it financially feasible to make a move now, even in a high interest rate climate, because it slashes the effective cost of that new loan. It essentially says, sure, the rate is higher, but you won't be paying that rate on a huge balance for long. We'll get you out of debt faster. For someone eyeing a new home but hesitant, this can be a green light to move forward. Let's say you bought your starter home at 3% and 5 years later you need a bigger place for your kids. Traditional thinking, I can't give up my 3%. Maybe I'll add an expensive addition instead, or we'll just cram in the house. But with the all-in-one loan thinking, if I get a new loan at 7% but pay it off in 12 years with my cash flow, who cares what the rate was? I'll end up paying less than I would have on that 3% 30-year fixed rate loan. It changes the math and the psychology. In fact, I've seen scenarios where a 30-year 4% and an all-in-one loan at roughly 7% had the same total interest over time because the all-in-one loan was projected to be paid off so much faster due to the aggressive principal payment. That means the borrower's cost was equal, but in one scenario, they were debt-free sooner. Also, for those who locked in a low rate but now have a ton of equity and want to tap into that equity for investments or paying off other debt, the all-in-one loan, it can be a great refinance option. Instead of a cash out refinance with a new fixed rate loan, you refinance into the all-in-one loan. It gives you access to the equity, the liquidity, and you manage the interest via your cash flow. You might stomach that high interest rate on what you actually borrow because you know you can pay it down fast or borrow only what is needed. Look, let me sum up the benefit here. The big idea, the structure of this loan can matter more than the rate itself. The all-in-one loan is an innovative loan that can potentially alleviate the opportunity cost of leaving a low-rate mortgage. It allows you to rethink the question, can I afford to move? It might change it to, how can I afford to move smarter? The underutilized benefit is giving up your freedom of movement and financial flexibility even when rates are high. That's huge in an environment where so many people feel stuck. They can't move. It's time to challenge the conventional wisdom that says, never give up on your low rate. If you find a better home or need to restructure finances, the all-in-one loan can be your strategy to do it without financial regret. Look, if this got your wheels turning and maybe gave you a glimmer of hope that you can make that move or take that equity, hit like and smash the subscribe button for more outside-the-box mortgage wisdom from MortgageWise. Share this video with anyone you know who's been lamenting, I'd love a new house, but I can't give up my 3% mortgage. They need to hear this. And I'm not sure if this is for you, but if you're curious about how the all-in-one loan could work in your situation, especially in today's rate climate, click the link below and I can run the numbers for you. And as a bonus, I'll give you $250 towards your closing costs if you go through with the all-in-one loan. That's basically free money to help you make a smart move. Remember, don't let old thinking trap you into an old home. There are always innovative solutions out there. Thanks for watching, and we'll see you next time.